In today's video, we're going to be discussing 9 key commercial real estate terms, including NOI or net operating income, a building's value, and the cap rate, and how all three of those numbers are related to each other when calculating a building's value. IRR or internal rate of return, LOI, letter of intent, TI, tenant improvements, 1031 tax deferred exchange, and cash on cash return. Before we get started on the first three main terms, there are more than one ways of valuing property. The way that we'll be talking about today, because it's used mostly for commercial buildings or trading commercial buildings these days, is the income approach, where you use a capitalization rate. The three other ways that can be used are a sales comparison approach. This is used quite often for residential real estate. A cost approach, where you compare how much it costs to build one building versus another, and a gross rent multiplier, where you don't calculate in any expenses, you just multiply the rent by a certain number, and you would compare that to another property by multiplying it by the same number. So the first three terms that we want to talk about, and they're all related, it's going to be cap rate, or the rate, and then the NOI, or the net operating income, and then thirdly is the value. So the cap rate, which is short for capitalization rate, it equals the amount of return you would get if you paid all cash for an investment. So most of the time, commercial building investments are financed or leveraged. So the cap rate, it's not a return of your investment unless you pay all cash. But it's merely a way to compare other commercial properties against each other and get a quick 1 year outlook on what the potential return would be, and then you can dive deeper and really figure out what the return is going to be. And for cap rates, they range anywhere from, well, actually even 4%, like 5% to 10%. The lower the cap rate, normally it's going to be better located, have a tenant that has high credit in affluent A parts of town. The higher cap rate is going to be a riskier investment. Some of your mom and pop shop businesses, there's going to be higher return, but then you're going to have to take on the higher risk. NOI, again, that's net operating income, and how you calculate that is basically you're taking your rent and any other incomes that your property receives. If you own a multifamily property, possibly other income you could get would be from laundry or something like that, and then you're going to subtract the expenses, and then what you have left is the NOI, so rent minus expenses. One thing that's not calculated in there is the annual debt service. That is something that, depending on your personal financial history and just who you are and how you're taxed, that's going to be different for everybody. So calculating the NOI is the same for everybody. How much or what your debt service is going to be different. And then the value, that's just the price or possibly what someone would pay for a commercial building. Now the formula to figure out all of these, you just swap the variables around, and you can solve for the third if you know two of them. So for cap rate, the formula for that is rate equals income over value, or NOI over value. To solve for net operating income, that is going to be the rate or cap rate times the value, and then value is solved by taking the NOI or the I divided by the R or the rate. Now let's look at an example. Say that there's a building here. It's $1 million. So the value is 1 million. The income or the rent that the tenant is paying you is 70,000, and let's say that the rent is 100,000, but then you're paying 30,000 in expenses. So that NOI is going to equal $70,000, and you want to figure out what the cap rate for that property is. So as you can see from the formula we just wrote down over there, to solve for R, it's going to be R equals the income, or 70,000 divided by the value, or 1 million. That's going to give you a value of 0.07, or 7% cap rate. Another good example we can use this cap rate formula for is, say that you have a tenant that is still, you are getting $70,000 income each year from them. So we'll use this value formula. We'll take this 70,000, and you want to know what your building's worth. Your brokers told you that other similar buildings in similar situations have sold at a 6 cap, or a 6% capitalization rate. So when you divide that by 0.06, that's going to equal 1,166,666. So you can see that when that cap rate changes from a 6 to a 7, or vice versa, that makes the value swing here. It swung almost $200,000. So as the cap rate goes down, then the price goes up, and vice versa. Now that we've covered cap rates, NOI, and building values, usually the next question, or even the first question, is what is my return, or my cash on cash return? So let's use this example of the $1 million building that has $70,000 NOI at a 7 cap. And we'll say that we're getting a loan from the bank at 5.5% interest, amortized over 25 years. What's that going to do? You have to pay the bank some of that $70,000 for loaning you some of the money. And also, let's say that you're putting 25% down on this $1 million building, so $250,000, and you're borrowing the remaining $750,000. So let's see what that looks like for what the actual cash on cash return is. Let's summarize this. We're putting $250K as the down payment, and we're borrowing the other $750K. So we need to figure out what the annual debt service is. There's online calculators for it, mortgage calculators, and what this comes out to be at that 5.5% interest amortized over 25 years is your monthly payment is going to be $4606. So you need to take that times 12 to get your annual number, and that's going to equal $55,272. So now we take that NOI of 70,000 and we subtract that to get our cash on cash return, and that is going to be the 14,728. And so if we want to get that to a percentage, remember that we put down $250,000. So if we take this 14,000 divided by the 250,000, that'll give us a percentage of that first year return. And so when we take that and divide it by 250K, that's going to equal about 5.9% cash on cash return. Another way to analyze properties is to use an IRR, or internal rate of return. This differs from the cap rate, where the cap rate is just a 1-year time frame snapshot. The IRR is over years most of the time, and if you would dispose of the property, it's going to calculate your proceeds in there and then spread it out over that time span. So the basic definition of IRR is the return on your money while each dollar remains in the investment. And there's calculators online that you can use to figure out what an IRR for a property would be, but there are some assumptions. You're guessing at what you're going to sell it, the selling price. So it's not 100% perfect. It's just a way for investors to get more of a broad view of what their return is going to be. The next term that we're going to look at is going to be TI, or tenant improvements. So these are usually asked for by the tenants when they are signing a lease and moving into a space for the first time or on renewals. Generally, it can be $10 to $20 per square foot, or it can be $0. But that acronym TI stands for tenant improvements. The next one is triple net lease, or sometimes you'll see the net. Basically, that means it's a lease where the tenant reimburses the landlord for all three nets. The three nets are CAM, which is common area maintenance, taxes, and insurance. So triple net leases are really liked by investors because if any of those expenses go up, it doesn't really matter to them because the tenant is going to be paying for that and covering it. So it has some security for the landlord, where they know that if taxes go extremely high or things have to get replaced or fixed or something with the property, that those expenses are passed on to the tenant. So they are guaranteed their base rent for their NOI. The next term we'll talk about is the 1031 tax deferred exchange. This is where you would sell one property and then trade up to a more expensive property, and you wouldn't have to pay taxes on the amount that you made from the sale of your first property. So there's lots of different rules that you have to follow with this, but this is a great way to start small with a small investment property and then work your way up to larger and larger properties so you can get the greater and greater cash flows without paying your taxes or delaying your taxes. The last term we will talk about is the LOI, and these are non-binding legal documents when you are making offers on properties or trying to lease a space. It's just a way for landlords or owners to work with tenants or buyers to agree on some basic terms without racking up high legal fees by drawing up the final documents, which would probably end up getting changed a lot. So it's just a way to find a common ground quickly with a non-binding agreement. And then after terms are agreed upon, then you would move to a legal document that was binding. Thanks for watching today's video. Don't forget to like and subscribe, and let me know what you think down in the comments.